day, everyone. My name is Gerard Linde. I'm the Director of Tax and Compliance. Today we're sitting again with Francois, Investment Advisor at 2. Today we just want to give you guys an overview of some investments, maybe some fundamentals, some vehicles, some tax implications on some of those. Just to give you like a broad overview of what you can expect from some investments and how to go about your business when you're trusting someone to do it or you do it yourself. So thank you for joining us, Francois, and yeah, the floor is yours.
Thanks, Gerard. I really appreciate it. Always fun having a chat with you. I think one of the biggest things that we're faced with on a daily basis is people not actually quite understanding different investment vehicles, and then within those vehicles, the different funds that are used. So I thought maybe we'll just have a chat about the different vehicles, the taxes involved with the various vehicles, and then obviously the funds, looking at duration of funds, the risk in funds, all those things that are basically used within these investment vehicles.
All right, sounds very good. So you can obviously, in your talk, you're going to probably discover like what type of person you are will probably play a role in the vehicle you want to choose or where you want to put your money in, maybe high risk or lower risk and what that means. So yeah, we're looking forward to see what you've got for us.
Yeah, Gerard, I think just on that, I think that's a very, very important little starting block is we always need to have a look at basically the time frame of your investment. So basically your risk capacity, and just to put it bluntly, your capacity to take risk, obviously. And when we look at capacity of your risk, you're looking at time frame. So anything from 1 to 3 years, your risk capacity is quite low. As the time frame goes on, your risk capacity obviously gets larger. So there's a little bit of a difference between risk capacity and risk tolerance. Now, a risk tolerance of a client is basically the amount of risk that is comfortable to take. So you get a lot of investors that are aggressive investors that like taking a lot of risk. They don't mind volatility within a fund. So they don't mind if the fund is up by 10% today and down by 10% tomorrow. Where other clients, you know, they don't like the volatility at all. They just want to know that their money is growing at a steady pace. And that's obviously where guys like myself, where we come in and we just advise our clients on various funds and basically just managing the expectations of the client and just giving them the right guidance on the correct funds to use for their goals. And I think that's very, very important. So that's a great little question straight off the bat.
Yeah, I can imagine. Yeah, after that, you have to determine your goal. What do you want to invest in for? What do you want to achieve? Assume the higher risks, I probably want to achieve, you know, something with a higher return in a shorter period, maybe to do something with it. Or that's just the way they are. Or people want to maybe save for the long term to either cover their house when they retire or buy a house or just look after themselves when they're done. So yeah, it's obviously, I think people misunderstand sometimes like why am I investing? What am I trying to do with my money?
Yep. And I think that's the biggest thing that we need to always identify is basically our period and then what are our goals at the end of the day. Because what we see a lot of clients investing in flexible investment options for retirement, and they're not actually using the right vehicle. So let's start off with that. So when we're investing for retirement, all right, what we want to do is we want to take that capital and we want to use it at retirement. Now in South Africa, legally, our retirement age is 55 years old. So this basically means that if you're making contributions to a retirement annuity, that the money is basically covered up until the age of 55. Okay, there are some rules like immigration and if you're permanently disabled, but rule of thumb is you cannot have access to the money in a retirement annuity before the age of 55. All right. What happens? Our contributions are basically tax deductible. All right. So let's say we put away the 2,000 Rand per month, it's tax deductible. So SARS will give you a little bit of a refund at the end of the financial year because you made those contributions. Now, we're capped to 27.5% of total income for the year, okay, to a maximum of 350,000 Rand. Okay, over contributions roll over to the next year. But that's basically the in and out of that. You're not taxed on the growth of the fund. All right. So there's no capital gains. You don't pay tax on the interest or dividends. Okay. So it's totally tax free. Plus you get a little bit of a tax break from SARS. Once you get to the age of 55, you've got the choice of disinvesting the money. 1/3 you can take as a lump sum. The other 2/3 need to be invested as an income. Of the 1/3 that we disinvest, you've got 500,000 Rand that is taxed at 0% or basically tax free. All right. So as a retirement vehicle, it only makes sense to use a retirement annuity to fund your retirement because you get your tax deduction. You don't pay capital gains tax. There's no tax on the interest or dividend withholding tax on that. All right. A little estate duty note, the money doesn't form part of your estate. It goes directly to your dependents. Okay. Now, another investment vehicle that's widely used is a flexible investment option. This is typically money that you can disinvest whenever you like. So if we're saving for a home, we want to buy a home in about 3 years' time, you want that capital to be liquid. Okay, so the money you put in, your 5,000 Rand per month or the lump sum that you invest, basically, you can withdraw that at any stage, no penalties, stuff like that. The only problem is you pay capital gains tax on the money. You do pay tax on interest. Okay, so as you know, we get a tax deduction a deduction of 23,800 Rand as an individual below the age of 65. So if your interest doesn't exceed 23,800, you don't pay tax on that. But if it does exceed the 23,800, you pay tax according to your marginal tax rate. You also pay your dividend withholding tax of 20%. And should you pass away, that money will form part of your estate, okay, which will attract executors' fees. And if it's over the 3.5 million Rand, you'll pay estate duty on that. So as well, you don't get any tax deductions for the contributions that you make. So again, two way different type of investment vehicles that have two way different basically goals. All right. And then what we've got is also got tax-free flexible investment options. So that's like a normal flexible investment option. So you can withdraw the money at any stage. The only thing is you've got a maximum of 36,000 Rand of contributions that you can make per year to this fund. Okay, so that's basically 3,000 Rand per month that you can put away. All right. Don't pay tax on interest, no dividend withholding tax, and no capital gains tax on that. All right. But, to actually have the benefit, the tax benefit of that, you'll probably only start getting the benefit after about 10 years, because then capital gains tax will start coming in. Your tax on your interest and dividends will only then start kicking in. So again, a nice vehicle to use. We normally say a tax-free investment option, you need to have that for a long period of time. Then it'll actually, start paying dividends for you as an investor. And then the last one that I would like to chat about is an endowment. So an endowment is basically a 5-year investment. And it's got a few rules to it. You can make one loan and one withdrawal against the value of the fund, but it's basically locked up, okay, for 5 years, and it's taxed at a flat rate of 30%. Now, long story short is this is great for investors that have, they've exhausted their tax-free investment option, their retirement annuities, and they're looking for something that'll have a tax benefit for them. So they will, if you're taxed at 45% marginal rate, your investment will be taxed at 30%. So you're actually saving your 15%. just by putting it in this wrapper. But again, it's got a little bit of a disadvantage that the money isn't that liquid to you. So you can't just have access to the money whenever you like. Now, one or two advantages of this is that the money is protected against creditors after 3 years that it's been active, and it doesn't form part of your estate in the event of death, and it can be used as security against the loan. So great vehicle, and it's got its own place within a client's portfolio. So that was just a quick little explanation, but I do think it's very important for people to just understand the various tax, the differences in tax, so that they can make the right informed decision when actually choosing an investment vehicle, when investing.
Yeah, definitely. I think your goal needs to be set, and then something that I'm interested to see, and it feels like markets play a role where we are at, and then certain things happen during a year that makes people panic, and that then they want to withdraw funds, or because they hear all this panic. Can you just run us through and show us some statistics? What happens over the course of a year, maybe 3 or 10, and why people, there is some cause for panic sometimes, but obviously take a step back and just look at the holistic picture. And before you make rash decisions, you put money in, now you want to take it out at the bottom, for argument's sake. You're either going to lose money or make no money. Where if you just maybe have rode out this wave, it gets through the panic, that there's always an upside and it will grow with time. And I think with any investment, if you're now short term or long term, and you need to take advantage of that, or be mindful of what's going on, because that's how a lot of people get caught or burnt when they lose a lot of stuff, because they make rash decisions when fear and panic takes over.
100%, Gerard. And I think the biggest thing that we need to also understand as investors is we need to give the markets time to be able to recover. Whenever there's a little bit of a downturn or a big downturn, we need to give the markets time to recover. Because the biggest risk in investment is basically the disinvesting. So when we decide to disinvest. Last year, the MSCI World Index dropped close to 35%. All right. Within a month, it was back at its normal levels. Okay. So if you decided to withdraw at the bottom, you were down 35%. Okay. You took the loss. But if you just stayed invested, if you remained invested into the fund, 1 month later, you would have been where you were. And in actual fact, you would have made quite a profit at the end of the year. So just remaining invested when we've got those bear markets are vital, just to make the right decisions. We always disinvest when we're in profit, never out of profit. All right. So I think that's just a normal sort of investing 101, just to make sure, listen, when the markets are down, don't disinvest. Give the markets time to basically recover and give you that growth. Last year was a great example of that in March, when we had all this panic in the markets and just panic in the world as a whole. People really wanted to disinvest. And the best advice we could have given our clients was to stay invested and to remain invested. And that actually brings me to my next point, is using the right funds for the right time period that we are looking to be invested. Okay. We've got funds, anything from cautious to aggressive funds. All right. And they're marked like that for a reason. All right. Cautious funds, basically, these are money market funds. They are, and it actually states that on the fund fact sheets, you will see it's basically a 1 year to 3 year investment. All right. And they say there that is the optimal time to remain invested. So they look to preserve capital and just to give sort of inflation returns. So the returns are quite muted, but you don't get the huge volatility that you would get in an equity fund. All right. Then you get fixed income funds, which are a little bit more cautious. They're on the cautious side. So they try and give you a little bit more return than a money market, like 2-3% more than a money market fund. And they also aim to protect capital and to give you a little bit more on the upside. But with that, again, as you go up the spectrum, the more risk you take, the more volatility you bring into your portfolio. Then we get balanced funds, which are moderate funds. Their optimal time frame is 5 years plus. And you'll see on the graphs that I've sent you, the difference in the time frame, 1, 3, 5, and 10 years. And as we start zooming out, we see, okay, the volatility actually becomes less within the portfolio as time goes on. And I want to be invested in something that's got a little bit more volatility over a long-term period, because that volatility will probably give me returns over the long-term period. But I need to know that with that volatility, the upswings and the downswings will become more and more and more. And as we go up the spectrum again, you get equity funds. So what I've sent you was the Allan Gray Equity Fund, which is mostly South African assets, and then the Allan Gray Orbis Global Feeder Fund, which is a global fund, and most people understand or know this fund. And what you'll see is over a 10-year period, the equity funds, okay, the Global Equity and the Allan Gray Equity Fund, they outperform all other funds over a 10-year period. But looking at a 3, 6, and 1 year period, or and a 5-year period, they've actually struggled. But if you left them and your goal was there for 10 years, you would have been in the right funds. If you were invested in a money market fund, you would have had basically close to 90% of growth over the 10 years, where an Allan Gray Equity Fund would have given you close to 150% growth, and the Allan Gray Orbis Global Equity Feeder Fund would have given you close to 413% of growth. So using the right fund for the right time period is extremely, extremely important, because you cannot put your retirement funds, again, I'm talking generally people that are more than 10 years away from retirement, you cannot invest all your capital in a money market fund, because you will come up short at the end of the day. So just by choosing the right fund, going through the various economic cycles, giving the capital the capital time to go up and down is of vital importance. But you must understand that, and you must stick to the game plan, and you must really have faith in the process.
Yeah, I think people need to understand what's fundamental in your mind. What is the investment, or what is the investor, and what is the trader? For argument's sake, if you invested in something, you are believing in a product and it believes in its growth, and you have to be in it for the long run. That's where we get it wrong. We want to see, because of all this quick and turnarounds quick, there are some vehicles that gives you a quick return, but that's obviously in what you do. You want to try trade maybe or something and you see a quick return, but if you invested in something and you believe in it, and you don't need the money, and you're in the right space and you're confident of your product, then obviously you will see the growth at the end of the time. It's just not something that you need to be hands-on all the time. If you believe in it, you leave it and you let it do its thing, and then you take your returns at the end, versus maybe cutting it short and you maybe lost 300% of your growth after 10, like your example said. So for me, yeah, that's basically where people need some reassurance sometimes, or need to speak to someone before making, so like you'll like we all call it sometimes, your life altering decisions in your life.
Yep, 100%. And as you said, I believe more in a buy and hold strategy. When we buy assets at a lower price, as their valued or as their true value, and then holding the asset for a long-term period, then trying to trade it. So yes, there are different strategies, but what we've seen over a real long-term period was buy and hold strategies just remain, they have less risk than trading the whole time, and they do deliver the best returns.
All right, so that was some good insights. I hope you guys enjoyed it. Francois, is there any final thoughts you want to leave us before we go?
No, I just want to thank you again, Gerard. And you know, if anybody wants to get some advice or would like to get in touch with me, please feel free. Yeah, I hope there's some good valuable insights. Just you know, touch on top of before we do a deep dive, but just some overview that you get some understanding of what you might get into or what you can expect. So if you guys like the content, smash the like button, subscribe, leave us a comment if you want to see more videos like this, or if you want a specific video, leave us a comment. If you want to get in contact with us, there is a contact us a link in the links below. So click it, follow through, give us your information, and we'll get back to you. Thank you for your time. We enjoyed it. Until next time, we see you.